For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. This is Show Me the Money with Randy and Jake Floyd. My name is Jeff Shade, and this is the show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm just here to ask the questions, but of course the words of wisdom and solid advice, well, they come from Randy and Jake Floyd of Floyd Financial Group. Randy has the week off this week, so hey Jake, how you doing this Saturday morning?
I'm doing great, Jeff. Thanks for asking.
You're certainly welcome, my friend. I hope everybody listening to us is having a good weekend. We're almost smack dab in the middle of summertime here, Jake. So let's dive into our show today. We've got a lot to talk about. I want to start off by talking about current events as we do every week, and I'll just sort of run down the list here. NVIDIA is a very popular stock, but it seems that there's a little bit of a crack in the foundation, is there?
Well, I think that NVIDIA has gone straight up for so long now that it got a little overbought. One of the metrics that we look at when we're trying to kind of gauge whether a stock's gone too far too fast is their different moving averages. There are technical indicators behind these stocks. And basically, just the 10-day moving average at the time when NVIDIA hit 140 was at 98, which means it's like way, way over its skis. Now, again, as anybody who's been listening to this show for any length of time knows that I'm a big fan of NVIDIA and have been for a long time. And I still am. I think this is a buying opportunity, not a time to run for the hills. And NVIDIA really hasn't given us a lot of buying opportunities over the last 18 months. So I think it's saying, hey, take this with my blessing.
Okay, so what you're saying is that NVIDIA has some room to grow. I would think it's such high figures that it's already, crested its wave, but you're saying that there's a little more room there to grow.
I do, and I think, if you look at traditional valuation metrics of growth stocks, looking at forward PE, which is price to earnings ratio, or looking at their 5-year revenue growth or year-over-year revenue growth, all those numbers are just astronomical on NVIDIA. If NVIDIA was not the size of company that it was, it would be trading at triple the valuation, probably. It's just the fact that it's, a $3 trillion company. It's just harder to steer the Titanic than it is a dinghy.
Right. Do you think that NVIDIA has any competition that may threaten it at all?
I think eventually there will be some competition. I think it's just very difficult for anybody to compete with NVIDIA because they have such a head start. Mm-hmm. They have all the business lines in place with all these major tech companies. They're buying all the silicon that TSMC can produce it to the specifications that NVIDIA is needing it. And so there's nobody else to compete right now. And in the tech industry, especially the chip industry, time is one of your biggest enemies. Every couple of years, you're creating the next generation, the next smallest, half the size of your silicon and all that. And so the further time goes, the harder it is to get ahead. Intel, frankly, a lot of people remember the Pentium and all that, but it was Intel's to lose for a long time. But they did, in fact, lose it. They got lazy. They got overtaken, and now they are, a few years behind NVIDIA and in some ways even behind AMD. And because of that, it's going to be very difficult for them to catch up unless NVIDIA drops the ball. I don't look for NVIDIA to drop the ball. Jensen Huang is the CEO of NVIDIA, and he is arguably one of the best CEOs, I would argue even in history, but certainly alive today running a Fortune 500 company. He's a very good CEO. He knows what he's doing. He knows his product. He knows his customers. So I don't think he's going to drop the ball, but that remains to be seen. That's why it's investing and it's not a sure thing, but at the same time, it's hard to find other companies that I like as well. The other companies that I like right now are the ones that are suppliers for NVIDIA, either software or hardware suppliers. Supermicro and some other companies out there are also look pretty cheap in the grand scheme of things. And people are like, how can you say it's cheap when it's up 1,000%? How much it's up really is not a valuation metric. What's a valuation metric is, relative to how much money it earns or how much money goes through its hands every year, the growth of the company. Those are valuation metrics. But Just the fact that it's up 1,000% doesn't mean it can't go up another 200 or 300%.
Talking with Jake Floyd of Floyd Financial Group, we're talking about current events, and we've talked about NVIDIA, which still has room to grow. Let's switch over to Bitcoin. I saw the car the other day, the Tesla had Doge on the license plate. I understand that Bitcoin has blown up a little bit, or has it?
Well, Bitcoin was starting to get pretty hyped up again. It went up above its previous high from a couple of years ago at 69,000. It got up to like 73,000, a little change. And the chart kind of looked like it was wanting to break out, but it failed a few indicators and then it started heading down. I don't think that Bitcoin's going away. Again, if you're a longtime listener of the show, you'll know that I don't really have a problem with Bitcoin and other cryptocurrencies. It's really more just you need to realize that investing in some of these altcoins is basically gambling.
Right.
You know, as long as you're okay with putting it in the slot machine and pulling the lever, that's fine. But just don't kid yourself when we're talking about investing. That's not the same thing. It doesn't mean you can't make money, but these coins don't produce anything. Therefore, we're not really investing in them. When we're looking at any asset class, you know, that was one of Warren Buffett's big bones to pick with gold for over the years, is that it doesn't produce anything. It's not a business. It just sits there and looks pretty. And while that doesn't mean you can't make money there, it does mean that it doesn't have the free market economic growth power that a business has versus a relatively stagnant asset. And again, that's not to say that Bitcoin isn't up 87 million% or whatever the number is today, because it is. It's up huge. There's no question. But I do think Bitcoin is one of those once-in-a-lifetime things that has gone up astronomically, but to think that it's going to go up that much again is probably not going to happen.
When Bitcoin first became a thing, I think a lot of people, doubters, said that Bitcoin is just a fad. It's going to go away. It doesn't look like it's going to go away. What do you think Bitcoin has to do, or what has to happen before Bitcoin is more accepted as an investment rather than a gamble, or do you think that it ever will?
So I think Bitcoin is more accepted right now. Bitcoin and Ether, which is on the Ethereum platform, those two are pretty well accepted in the traditional finance channels at this point. All the other ones, there's a handful of them that actually have some use cases, but a lot of them are just pump and dump schemes, right? So there's one out there where there's this famous investor on X, which, formerly Twitter, and his thing was buying these little penny stocks and pumping them and then dumping them before everybody else got out. So he'd get all these people hyped up and they'd go out and buy it, therefore pushing the price up for him, and then he would exit without telling them, right? Taking their money, and then it would crash and then they would leave. And so he got in trouble with the SEC. And so 2 years later, what does he do? He goes out and he creates his own cryptocurrency in his name. And there's nothing going on in this cryptocurrency. There's no reason to think that it's going to be good or anything. It's just him pumping it, saying, hey, I got $5 million or whatever it is, and him going around getting other people to invest in it. And again, I'm sure he will do the same thing, which is pull the rug out from under these people. So a lot of these altcoins are pyramid schemes, right? Somebody created them, and then they're selling them to everybody else, and they need everybody else to keep buying them to prop the price up. You got to be aware of some of those. Again, that does not mean that you can't make money, and there are people probably listening to this and be like, hey, I made money in XYZ coin, and I understand that, but that doesn't mean it was a good investment. And especially when we're talking about people's retirement assets, we need to be very careful because you can't afford to have to go out and do retirement again. So if you are thinking about Floyd Financial Group as potentially managing investments, know that we are not going to go out and invest in all this stuff. We're about, what we can see and touch and places you like to shop, and we're not about nebulous things that may or may not exist somewhere out in the ether.
Our telephone number here at Floyd Financial Group, by the way, if you have questions about anything that we talked about, 417-889-7233, 417-889-7233. We would love to hear from you. When you talk about Bitcoin, Jake, I think about the .com era, and when all these websites came up, anything with a .com would automatically become worth a lot of money. Then the .coms turned into the .bombs. Do you think it's the same thing with Bitcoin? Do you think that Bitcoin will have its day?
I think not only is it the same thing, I think it's much more egregious because they don't even have to buy a building to go public. So just for context, in the late 90s, early 2000s, I'm trying to remember the exact number, so I'm on the air here, so don't quote me on this, but I think it was over 200 companies that actually went public that didn't even have a business. They just named themselves, like you said, something.com, and they went public, and people poured millions and millions and millions of dollars into these companies. And somebody just exited with the money and folded up shop. And then later they got raided by, the FBI or whoever. They go into this building. It's just empty. just a bunch of empty cubicles, right? There was no actual business. And that number is, again, somewhere between 150 and 250 companies that did that. And these altcoins are the same mentality. It's not to say you can't make money. And some of those companies that weren't even companies, if you got in at the right time and out at the right time, you could have made money. But that doesn't make it a successful business.
We're talking with Jake Floyd of Floyd Financial Group. Jake, let's talk about possible rate hikes. I understand that Fed member Bowman is open to rate hikes, although other people are saying that it's not going to happen. What's your opinion?
I think personally that this is jockeying for position for the Fed as a whole. And some people sit there and call me a conspiracy theorist about this. But what I really think is happening is these Fed members are getting together and be like, how do we keep people guessing? How about you go on CNBC tomorrow and say, hey, I think I might be open to a rate hike instead of a rate cut, just to keep people on their toes. And last week we talked about this. I really think the first rate cut is going to be September. I don't think we're going to go anywhere in July. There's mounting evidence that they're going to have to start cutting rates before long. Otherwise, prices are going to start to go negative. The Fed does not want that, and that leads to recession or worse. So I really think that we're going to see cuts in September. Also, if you're politically minded, that would be the last opportunity to cut rates before the presidential election. The Fed is supposed to be a non-political organization. However, there's been times over the years where it seems like that may or may not be the case. So get ready for everybody to get their tinfoil hats out on if he if he starts cutting rates on the last possible opportunity before the election.
And if we do have a rate cut, it's probably going to be about 0.25%. And we can't end this conversation, Jake, without talking about inflation. I understand inflation numbers are coming down, but prices are still up.
Yeah, I think it's important that people understand, too, that just because inflation's coming down, all that price increase has been baked into the cake now. Just because it's not going up more doesn't mean it's actually coming down. And this is something we've talked about several times on this show, but I think it's important that people understand, inflation's back down to 2%. Does that mean that prices are down? Absolutely not. It just means they're not going up by as much as they used to be. Even if we use the Fed's dumbed down numbers of 15 to 17% over the last 2.5, 3 years, I would suggest that number in many areas is more like 30 to 50% in price increase. And I think anybody listening to this, that's been to the store recently would probably agree with that. But there's no going back from that, really. And if your investments are not up a lot over the last 3 or 4 years, you may just find that you're spending more and don't necessarily have it to spend. It's important to understand that inflation, while it is going down, prices are not probably going to come back down unless we have a total falling apart of the economy.
Talking with Jake Floyd here at Floyd Financial Group. We're talking about current events. And before we continue, Jake, I want to take just a moment here to talk to our listeners about how they can get in touch with you and have a private, confidential conversation about their retirement journey. All you've got to do, and you can do it this weekend, is call 417-889-7233. Again, our number, 417-889-7233. That is the number that you call to ask for your Floyd Financial Group retirement review. Now, it's not going to cost you a dime. There is no obligation whatsoever. And certainly there is no judgment. Simply leave your name, your telephone number. Ashley will call you back next week and set up that appointment for you. Once again, our telephone number, 417-889-7233. Make that call this weekend because this one call really could make all the difference in your retirement journey. Jake, we're going to take a break. When we come back, we're going to be talking about how to replace your salary with a retirement paycheck, the mechanics of that and more when our show continues right here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shade.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about how to replace your salary with retirement income.
And Jake, that is a big concern that I'm sure a lot of people have. You've had a paycheck for 30 or 40 years. You could depend on that. Well, most of the time you could depend on that. It could come, every week, every 2 weeks, every month. But then you get into retirement. That is my biggest worry is, okay, how am I going to replace this paycheck and how am I going to make a paycheck that is going to be reliable? So let's talk about the mechanics of that. Jake, I come into you and I say, Jake, listen, here's my 401k, has X number of dollars in it. How do you turn that into a retirement paycheck?
Yeah, and I think the mechanics of that is something that a lot of people have questions about. It's something that we do in here every day, turning money into income, for people after they've retired. So it's kind of second nature to us. But some people are like, how do I actually turn this chunk of money into income? And do I get a regular paycheck, or do I just have to request it every time I want it? And the answer is yes. However you want it to be, it can be. In fact, it's probably significantly more flexible than your current paycheck that you get, meaning if you have to get it every other Friday, that's kind of just when you get paid, versus in retirement, you can set it up where you get weekly checks, bi-weekly checks, monthly checks, however you want it to be. We can choose how much gets sent specifically to the government so that you don't have to pay quarterly taxes if you don't want to. If you prefer to do that, that's fine. As we're thinking about how do I take this $500,000 or this $1 million and turn it into $2,000 a month, $4,000 a month, whatever it is, and how do I be sure that I'm not going to run out of money? That's one of the main things that we do here at Floyd Financial.
Okay, so I've got, let's say for the sake of argument, I got $500,000 in my 401k. If I do not make any money on that, it's going to last for a set period of time. So that brings up the next question, Jake, is, okay, I don't know how long I'm going to live. I could live to be 95, 100 years old. So how do we invest that money to create this retirement income that we can't run out of, or is that even possible?
So it is possible. So as we're thinking about income and how much that we need to pull, there's something out there called the 4% rule that a lot of economists and other planners subscribe to. The 4% rule simply says if I take 4% of my balance each year in income, I have a very high likelihood, 99% plus chance of not running out of money, assuming my money is not mismanaged. I would agree with that statement as far as the 4% rule, but I would even push it maybe even to the 5% rule, because I think you can pull 5%, maybe even as high as 6% under certain circumstances. If we have protections in place and guarantees on the money in place, we obviously can't be pulling 15% of our money every year if we want it to last. And so there will be years where the market is kind to us and other investments are kind to us, and you might make 15% a year, but that is not going to be the norm. And so we need to act accordingly with our income. Now, the other thing about starting at 4 or 5% of an income stream is as time goes forward, if your money is being managed correctly, you should have some uptick in your balance of your investment. And then if we stick with the 5% rule, then that means you can get a raise, right? Instead of having to live on the same amount of income for 25, 35, 40 years of retirement, depending on when you retire. And so it's my job to try to help my clients understand what's possible, make sure they're taking the right amount of money, make sure they're taking enough risk but not too much risk. And that's not me bending what you want. It's more just informing you of how the whole game works, if you will. And because I've helped hundreds and hundreds and hundreds of people retire, and you're only going to retire one time, I can help save you from some of the potholes and the pitfalls.
Jake, you talked about raises, and with most jobs, you would get probably an annual raise. Sometimes it's a little more than the cost of living, but do you build in these raises, and how do you determine how much raise that someone needs?
Yeah, and so it really depends on the person and how much income they have outside of their investments. So I have people that have Social Security, for example, has a built-in cost of living adjustment. Some pensions have a built-in cost of living adjustment, some don't. But when it comes to trying to craft an income plan, I personally think it's a mistake to think about that one time at retirement and never think about it again. So as you come in for 90, 120-day reviews, this is one of the things we're talking about, especially right after you retire, where you say, hey, let's turn this income on. We're going to turn it on so it comes every first of the month. We're going to hold 12% out for taxes or whatever the number is, whatever number is appropriate, right? Those are just examples, not advice. But after 90 days, I want to have you come back in and we'll say, okay, so is this amount of income feeling about right? Is it too much? Because if it's too much, we may not want to take as much out, because if it's coming out of an IRA or a 401k, then, we're just paying taxes on that money for no reason. So let's dial the income back a little bit. Conversely, if it's not enough, we may need to increase the income, but that's why it's important to stay in constant contact with your advisor. And if you have an advisor and you haven't talked to him in, 2, 3, 4 years or whatever, that's really something, give him a call or give another advisor a call or whatever, right? And I understand that some advisors do get busy and that kind of thing, and it's not necessarily that he's avoiding you, but you do need to be in contact with your financial advisor, especially around retirement. I recommend doing 90-day reviews, maybe 120-day reviews. That way, as things change And as you get used to retirement, we can make adjustments on the fly if necessary.
Jake, sometimes at a job you'll get a holiday bonus or you'll get a bonus for performance, something like that. Or let's say that you have an unplanned expense, the car dies, and you need enough money to buy a new car. Is that something that you can do with this retirement income plan, is create a paycheck or sort of a bonus paycheck that maybe you will need or maybe you don't need it?
Yeah, and sometimes that's why we build in, a 3 or 4% income stream where we could build in a 5%, but we know that around Christmas, you're going to want to give money to the church or to your kids or whatever it may be. So that's why it's so important to really understand each client and what's important to them and make sure that we're doing what you want to do with your money in retirement. And staying in contact and talking about those things, is a big part of that. But the answer is yes, we can absolutely get money out as needed. Now, we have to be a little careful that, if we're already taking 6% and then we start taking 2% withdrawals 3 or 4 times a year, right, you can run out of money. But we want to make sure that we think about all these things on the front end. And it's also my job to sit and monitor things and make sure that if I feel like if we're spending too much money, I reach out to you and say, hey, maybe we should come in for a review and kind of talk about this to make sure that we don't risk running out of money. And so that's one of the reasons why a lot of people think that I just manage retirement money and that's why I get paid. I would say, honestly, that's kind of an ancillary thing that I do. The main thing that I do all the time is help people navigate retirement. Should I buy this car? Should I not? Should I buy this house? Should I refinance my house? Should I give this money to my kids? What's the consequences if I do that? What should I pay quarterly taxes? Should I, all these types of questions are questions that I get all the time. And I spend probably more time doing those than I do actually making investment decisions and things like that. Although I am very glued to that kind of thing, there's a lot more to retirement than simply just managing the money in the market or other investments.
We're talking with Jake Floyd of Floyd Financial Group, and we're talking about how to replace your paycheck and create a new one with your retirement savings. Again, our telephone number, if you've got questions, you want to talk to Jake, 417-889-7233, 417-889-7233. No cost, no obligation to have a conversation with Jake. So take advantage of this opportunity. Make that call this weekend, 417-889-7233. Okay, Jake, so you've taken my 401k money, you put it into a variety of different investments. Some may be very secure, some may be designed for growth, some may have other objectives. How do you decide where to withdraw the money from first to make it last when you have several investments?
That's a very good question, Jeff. I'm not sure we'll have quite enough time to go into all of that, but I'll just give you kind of the basic idea. So let's say that we have money, half of it's safe, half of it's at risk in the market. And again, this is going to be a little bit of an overgeneralization just because there's literally millions of scenarios we could play out here. Let's say we have half the money safe, half the money in the market. If we have that situation and let's say the market is off, 20% at the time, we're having a 2022 moment. What I would probably do is take money out of the safer investment and give the market time to come back before we start spending money out of that depleted dollar. Now, that's going to vary quite a lot between who this person is, how much risk they're taking, what their risk tolerance is, how much money they're taking from their investments from an income standpoint, whether it's one-time or monthly income. I mean, there's a lot of factors there. But in general, it's usually not a good idea to spend money out of a depleted dollar. If the market is off, we'd like to give it a chance to recover, especially if our safe bucket is capped on what it can make. And again, there's a lot of variables there. If markets are up a lot and maybe at an unsustainable level, sometimes we will skew investments toward the more risky investment, specifically to curtail the risk on the overall portfolio. So if I take money out of where it's up huge, and honestly, this is somewhat how we're thinking about it right this moment with the market being up as much as it is. If I have a client call and they have a pretty balanced setup, I'm say, hey, let's take it out of some of the risk assets. They're up a lot. And that'll help bring us back into balance a little bit too at the same time. So I don't know if that answers your question, but it is a little bit of a complex scenario, but it is something that I deal with on a daily basis.
Jake, for those people who are just joining us, I want to circle back to the mechanics of this. Once again, if you've received a paycheck weekly, bi-weekly, monthly, something like that, you can do that there at Floyd Financial Group. You'll receive it however that you want to receive it. So where does this check come from? It's going to be direct deposited. Does it come from Floyd Financial Group or does it come from some custodian? How does that work?
Yeah, so Floyd Financial Group is not a custodian of money. I think this is a very important thing that I talk about in meetings, but I don't talk about on the radio a lot, and I think this will be helpful. So a custodian is someone who holds money. They have custody. So like Charles Schwab or Fidelity would be a good example of a custodian. It's their job to hold the money. I have what's called discretion over the accounts that I manage. I mean, I can buy and sell as I see fit on behalf of my clients, subject to their risk tolerance and things. A lot of people remember this guy, Bernie Madoff, right? Bernie Madoff could steal money because he had custody.
Yeah.
I will never have custody of any client's assets. I don't want to have custody. That's an important distinction. You will never write a check to Floyd Financial Group or to Jake Floyd or anything for an investment. It'll always go to a qualified third-party custodian.
If you're interested in finding out more about what we talked about, maybe you've got money in a 401k or some other investment account, you'll want to turn that into a reliable retirement paycheck. We certainly do invite you to give us a call here at Floyd Financial Group and talk about just that with Jake Floyd or Randy Floyd. You can do that this weekend by calling 417-889-7233. If you call that number this weekend, all we ask is that you leave your name and telephone number so that Ashley can call you back during the week and set up an appointment that's convenient for you to have this casual conversation. Again, there is no cost. It is no obligation whatsoever for this call, and certainly there is no judgment whatsoever. We will meet you where you are. So go ahead, take advantage of the opportunity right now to make that call and get the help that you need to put yourself on a path towards a confident retirement. Once again, that telephone number, 417-889-7233. You can also find out more about the firm online at Floyd Financial Group. That's floydfinancialgroup.com. Jake, we're going to take a quick break. When we come back, we'll be talking about ways to take advantage of high interest rates while they last. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shade.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about different ways to take advantage of interest rates while they're still high from an investment standpoint.
And Jake, if you've taken a look at some CD rates, you see that we can get 5% relatively regularly. If you take a look on the internet, you go to your local bank, many times they may not be able to pay you that much, but right now around 5%. So let's talk about how to take advantage of these interest rates while they are still high. We'll sort of go down the list here a little bit, and let's start it off with something very simple as a CD. So what are the pros and cons of putting money into a certificate of deposit with rates this high?
Yeah, I think too, Jeff, that it's important to understand that 5%, usually when we're talking about that number, is an annual rate of return.
Okay.
Meaning if you have a 3-month CD, you're not going to get 5%, right? If it's a 5% 3-month CD, you're going to get 1.25% or something like that because it's an annualized rate. And so a lot of people don't make that connection where they're like, hey, I'm getting 5% over 3 months. No, you're getting 5% as an annualized rate. The first thing I would just say too, Jeff, I'm going to back up a little bit and just say, if you have money sitting in savings accounts and checking accounts, I would definitely look at if your bank has a money market account or a short-term CD that you can do, because there's still a lot of people earning nothing on their money or close to nothing. And there's really no reason you shouldn't be making, 3 or 4% at a minimum, even on liquid money. And if you don't have a bank that has a relationship like that, give us a call. I can direct you to a couple banks, and or we can use money market mutual funds to do some of those types of things. But that's a conversation we can have. But again, just make sure that you're getting paid for your money, because a lot of people, are so used to not getting paid for their money over the last 15 years that they're scared to ask. Definitely go in that bank and tell them how the cow ate the cabbage, and tell them, hey, as my grandpa would say,
yeah,
and tell them, hey, people are earning interest. I want to earn some interest on my money. And for the most part, the squeaky wheel does get the grease. So go in there and complain about your interest rate a little bit. You might get some favorable adjustment. So back to your question. A CD is a certificate of deposit is basically a time deposit, meaning it has a term from 3 weeks to 10 years in that ballpark usually, where we say, hey, we're going to pay you this annualized rate of interest, let's say 5%, for 3 months, 6 months, a year, whatever the number is. And so during that period, you do not have access to the money. There's penalties if you take money out of there. So you need to understand, in banks, what kind of penalties there are associated with that. Inside of a brokerage account, you can buy CDs, and then you can simply buy and sell those CDs. And there's other risk factors at work there. But When it comes to CDs, the term and then the interest rate are the two main factors contributing to the investment.
Okay, so I know we don't have a crystal ball here, Jake. How much longer do you think, in your opinion, that we're going to be able to enjoy 5% interest rates?
I think we're already starting to see the end of the 5%. There's still some places out there you can get 5%, but it's not every single financial institution the way it was 6 months ago. The banks are starting to anticipate the Fed cutting rates. Ultimately, the Federal Reserve does control these rates through something called the federal funds rate, which is the rate at which banks can borrow money from the federal government overnight. And so that indirectly controls all the different interest rates out there. So when we're thinking about interest rates, the main question to ask is, when is the Fed going to cut interest rates and why? Right? So there's two potential reasons why they might cut rates at some point. Number one is, the job of defeating inflation is over, and therefore we can move to a less restrictive stance of monetary policy, meaning lowering interest rates. Number two is, oh crap, we overdid the rate hikes and we're destroying the economy, and we better get rates down really fast to save it or even potentially stimulate the economy. But it's hard to envision a scenario where interest rates would remain this high and not be damaging to the economy long term, damaging to new business startups and all kinds of things, damaging to wage growth, job growth, all those types of things. So I think it's just a matter of when more than a matter of if interest rates will come back down. Is it going to be 12 months or 36 months before they come down meaningfully? And I don't know that anybody has that crystal ball, but it does look like rate cuts are probably coming before too long.
We're talking about ways to take advantage of high interest rates while they last with Jake Floyd of Floyd Financial Group. Once again, our telephone number, 417-889-7233. It's 417-889-7233 if you'd like to have a conversation with Jake. Jake, can you have too much money in a CD or a money market? I mean, how much is too much?
So total dollar amount, no. I don't think there's really a number that's too much necessarily. But as a percentage of what you have, yes, I think there's a way to have too much. Again, we're always seeking balance in a portfolio, and where that balance needs to be is dependent on the individual, how much money you need in retirement, how much risk you're comfortable with. But I do think that if you just have all your money in CDs all the time, recently that has been a potentially winning strategy, I guess, but it depends on how you look at it. And so when we're thinking about what is prudent for an investor, we need to understand more than just how many dollars they have in CDs. It's more about what's the balance, what is the money for, what is the purpose of this money? Are we looking at leaving it to a beneficiary? Are we looking at spending it in retirement? Are we looking at spending just enough to live on and not more than that and growing it? What are the goals? Are we looking to put a down payment on a house? So that's obviously a very different scenario. And so all those things come into play when we're trying to figure out how much is appropriate in CDs. Although it just, CDs just feel better as a whole right now than they have in a long time. And so there's a lot of money flowing into CDs and money markets over the last year or so.
Jake, for the purpose of this conversation about high interest rates, is this a good time for fixed index annuities?
Actually, yes, Jeff. I think fixed index annuities are, a hybrid type of annuity that are interest rate dependent and they're volatility adverse, basically, right? So in an environment like this where volatility is relatively low and interest rates are relatively high, it's a very good time to use a fixed indexed annuity. It can help us to lock in interest rates in a way that's very difficult to do outside of here, because as you go out the time frame, you may be able to get a 5% 1-year CD, but try going and getting a 5% 5-year CD. You're not going to be able to find it. And the reason for that is interest rates, like I said, are likely to come back down, and these banks are anticipating them coming down. They don't want to be left holding the bag. And so as you go more than a year out, it's very difficult to maintain that 5% on a CD. In a fixed annuity or a fixed indexed annuity, depending on the situation, depending on which product we're talking about, there are some cases where you can lock in higher rates than that for much longer, 5 years, 7 years. Again, there's a lot of factors to consider, and I'm not just saying, hey, you need to go buy an annuity. I'm just saying it is a favorable time in history to purchase a fixed indexed annuity or a fixed annuity based on where interest rates are right now.
Talking with Jake Floyd of Floyd Financial Group, again, taking advantage of high interest rates. Let's shift the conversation here, Jake, to treasuries. How do treasuries come into this conversation?
Yeah, so treasury yields, we've had an inverted yield curve for basically 2 years now. And what that means is intuitive knowledge would suggest that if I have a treasury bill that's a year out, right? So I'm letting the government borrow my money for a year, that interest rate should be higher than one that's 6 months out, right? Because I'm tying my money up for longer. And that's how it normally works. Right now, the yield curve is inverted, meaning the shorter the duration, the higher interest it pays. And so because of that, it's very hard to get treasuries to pay much yield out past about 6 months to a year, which is also indirectly controlling the CD rates we were just talking about. But when it comes to treasuries, there's nothing wrong with them, right? You're backed by the full faith and credit of the United States government. Some would argue that maybe that's not as good as it once was. Personally, I still love this country. I don't think we're on our way out. I think we're still just getting started. I don't have any issue with holding treasury bills. If interest rates come down and you have longer dated treasury bills, you could also experience appreciation in the price of those. Meaning if you were to sell them, you could get more than what you paid if interest rates come down. So that's another reason to potentially use some treasury bills inside the portfolio, especially to help offset risk in certain areas like tech stocks and other things. Again, this is all very general advice. I don't know the listener's risk tolerance, all that kind of thing, so don't take this as investment advice. But generally speaking, as treasuries have been pretty awful for the last 10 years, but right here, they're starting to look a little bit more attractive.
Okay, so we've talked about CDs, money markets. We have talked about fixed index annuities, treasuries. Let's wrap up this conversation about taking advantage of high interest rates while they last and talk a little bit about bonds, Jake.
Yeah, so treasuries are a type of bond, but when we're talking about corporate bonds, let's say, which is the same thing, but just with companies borrowing the money instead of the government, they're also in a fairly favorable scenario here. I would probably be a little careful with some of the high yield stuff out there right now. Personally, that's a personal opinion. Higher yield usually just means a little bit higher risk in the company that you're taking those bonds out in. So if you lend money to the wrong person and they don't pay it back, that's a problem, right? Mm-hmm. So it's the same thing with companies. So we got to be a little careful who we're lending that money to. But bonds in general look pretty good over the next, year or so, in my opinion. Once interest rates come back down, however, we'll probably want to seek something else to invest in, because then we'll be back in the boat that we were in for the last 13 years preceding the last two, which is very low interest rates, and we're kind of standing on the train tracks. If interest rates go up, the inflation train coming to run us over.
We've been talking with Jake Floyd, Floyd Financial Group, and we've been talking about ways to take advantage of high interest rates while they last. If you have questions about investing in CDs or money markets, treasuries, bonds, fixed indexed annuities, we would love to have a conversation with you. All you've got to do to get that conversation started is to give us a call here at Floyd Financial Group. You can do that by calling 417-889-7233. Again, our telephone number is 417-889-7233. Again, no cost, no obligation for this consultation, and certainly no judgment. Again, make that call this weekend, 417-889-7233. Leave your name and telephone number. Ashley will call you back during the week and set up that appointment for you, and a convenient time for you and Jake and or Randy there at the firm. 417-889-7233 is our telephone number. Again, we would love to sit down with you and have this casual conversation with you about how to get you on a path towards a confident retirement. So take advantage of the opportunity this weekend, 417-889-7233, and be sure to visit us on the web. Find out more about us online at floydfinancialgroup.com. It's floydfinancialgroup.com. Jake, we'll take a break again. When we come back, we want to talk about the 5-step process, what it's like to come in and have that conversation with us, and we'll talk about that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpa, Jake Floyd.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to be talking about what it looks like if you come in for a free consultation to see us, what exactly we go over.
And Jake, in your illustrious career there at Floyd Financial Group, Randy has been doing this for a long period of time. I mean, many, many years, probably over 20 years, maybe close to 30 years. But you've been there for 17 years, so I would imagine that you have had hundreds, if not thousands, of conversations with people. So I wanted to break it down for people here who wonder what this initial consultation is going to be like. So where do we start with this, Jake? They come in and they sit down with you. You go through your visiting. What comes first here?
Right. So what I want to do in our first meeting is really get to know you. Get to know what's important to you, what makes you tick. Is family the most important thing to you, or are you a single person and you have a charity that's important to you, or what is it in life that gets you up in the morning? Once I kind of understand who you are, that helps me to create the framework for a plan for you. Because there's certain types of investments and different strategies that may not apply to a family person the same way they would apply to a single person. And it doesn't make sense for somebody who is single to have the same plan as a family that has 3 kids, with kids in college, right? And the demands of a plan are very different. So the first thing we do is I really just want to get to know you.
Okay, so we call that our discovery process. What are some of the things that you need to know about them beyond, hey, I'm a single person, I'm a married person, I've got this much money? I mean, when you talk about people's dreams, hopes, their visions for retirement, what are some of the more important things that will help you move on to the next step, though?
A lot of times I'm talking to people before they retire, so I want to know what it is that you like to do with your free time, for example. If you like to fish and you like to fish from the bank and you don't really want a boat, and you can do that very inexpensively. And a lot of my clients are very frugal. However, I do have clients that what they want to do in retirement is travel the world and spend 3 months a year in another country. That's less cheap, right? And so when you retire, you suddenly have more time to fill. And so we need to understand what you're going to be filling that time with so that I can understand whether you're going to need more money in retirement, less money in retirement, how often you're going to need that money, whether we're going to do, like we talked about in the other segment, whether we're going to do monthly withdrawals or weekly withdrawals, or if you're just going to call me when you think you need some money because you got a trip coming up and otherwise you don't need anything because you have enough guaranteed income otherwise. There's a lot of different ways this can play out. And like you said, Jeff, I've had literally thousands of conversations with people about this. On average, I would say the average person is 75 or 80% of their salary to live on in retirement. And that's because you don't have a lot of things that you're funding anymore, like your retirement account or Social Security tax, you're in a lower tax bracket, all that type of thing. So those are all the types of things that we want to understand. What's important to you, but also what you want to do with your time once you're in retirement.
Okay, so you're not being nosy, you're asking these questions for a purpose, and sometimes I would imagine that these discovery sessions can go off on a little bit of a tangent, especially if Randy's there, because many times, Randy's been around long enough that he knows people that they know, and, he'll talk about, hey, are you related to the Harkin Farkers in Bradleyville? And it gets into that sort of conversation. You really like to get to know your clients. Okay, so that is the discovery process. Then what is next?
Yeah, so after we get to know each other, I see what's important to you, what you guys have for assets in retirement, that type of thing. Then I kind of go to the drawing board and I say, okay, what's the best way to accomplish the goals of this person that I just met? And we set up a second time to get together. And in between those 2 times, like I said, I go to the drawing board, I create my spreadsheets, and I kind of go through things and say, what's the very best way, the simplest way, right? We don't need to make it complicated for the sake of making it complicated. But we also want to make sure that we accomplish all the goals that you have. And what financial tools, products, investment strategies do we need to employ to get you to where you want to be?
Okay, so the first is the discovery process. Then comes the analysis, as you said. That's where you go to the drawing board. And again, this sounds like 2 meetings. Is that where we are right now?
So right now, the analysis, the second step is between the first meeting and the second meeting, right? So I'm kind of going through things mentally. And then the third phase is where we start to talk about the plan with the client. So I come back in the second meeting and I say, hey, I had a chance to think about this, and here are the things that I think we should do to put you in the best situation, or help put you in the best possible situation that we can get you to accomplish your goals, make sure that you don't run out of money in retirement, and the other things that are important to you. And here's how I think we should do it. Now, again, after I unveil that, I'm not going to ask you to make any kind of decision. Some people are like, well, hey, I have a low-pressure process. We have a no-pressure process. Like, when I'm talking about this stuff with you, I'm never going to be like, hey, you want to do this or what? My goal is just to help educate you and help you understand how your money is going to work for you in retirement. And that's what we do usually in the second meeting.
So when you come in, it's a 5-step process. We've covered the discovery, the analysis, the planning part, and then comes what? Implementation? How does that work?
Yeah, so after we've met a couple times, a lot of times what happens is I'll set up a third meeting for you to ask questions. And if you decide between the second and third meeting, you're like, I don't think this is for me, that's totally fine. I've made a new friend, and that's great. You just call us and say, hey, I'm going to call it good at 2 meetings. However, usually we set up a third meeting. That way it's on the books. So if you want to come in and ask some more questions after I have kind of unveiled the plan to you, that'll give you a chance to get your questions answered. If at some point that you decide, hey, I'm ready to move on board, then we go into the implementation process. This is where we do all the paperwork. Again, in today's world, if it doesn't take 100 sheets of paper to get it done, it's probably a scam. And that's just kind of how the regulation of this industry works. So we have a little bit of a paperwork party. It's not as bad as I'm making it sound, but take 20, 30 minutes of paperwork to get through everything, depending on the situation. But we go through, we open accounts and have monies moved from wherever they are, if necessary, depending on the plan. And that's the implementation process, as we kind of get everything there. We make sure you get set up with all your logins to all your new accounts, if we've opened new accounts, and make sure that everything is the way that we had planned it out to be.
Okay, Jake, so from discovery to implementation, how long does that usually take? I mean, is this a week process? Is it 2 weeks? Is it a month, 2 months? How long does that usually take before we can get the ball rolling?
So in the summer, it goes a little bit quicker. Summer is my slower time because a lot of people are out with family and that kind of thing. It takes a little longer if we do it toward the beginning or the end of the year. But right now, if we came in for a discovery meeting, a lot of times I'm meeting with you the second time in a week to 10 days. Mm-hmm. And then there will be, again, about a week or so for you to think about things, come up with questions. From the time we actually decide to implement things, start to finish, it might be another 3 weeks or so. And so the whole process, might be a month or a little bit longer. But again, we're not in a big hurry. This is your financial well-being, right? This is your life savings. So,
right.
If it's a good idea today, it'll be a good idea tomorrow. We want to go as quickly as you want to go, but at the same time, we want to make sure we do everything correctly and nothing gets missed and everything goes smoothly, because we know how important this is.
Jake, I know that markets and the economy, there are all these different factors that may change. Are your plans set in stone, or can they be flexible and malleable with the market and with the economy?
Yeah, I would say that one of the biggest things that we focus on here is the ability for the plan to change. I don't know what your retirement is going to look like. I can promise you, though, that it's not going to be exactly what you're envisioning, because life has changed. Things change, circumstances change, things don't work out the way you thought they would. And we need to have flexibility in every plan to be able to adapt around those changes. I don't want to set something up that's going to kick off X number of dollars in income, but then you can't get to the rest of the money, right? I want to have something that we can change and massage and work into as the plan unfolds over the first 3 months, 6 months, year, 10 years, however long it is. We need to be able to have some flexibility built in there so that if we need more income or less income or taxes change or have a death of a spouse or whatever it may be, that we have some flexibility built in to accommodate that.
Okay, so in the beginning, I said that this was a 5-step process. You have done discovery, analysis, you've done the planning, the implementation. The last one here is going to be follow-up. So how often should someone follow up with you, or do you follow up with them?
Yeah, so the review process and the follow-up process it's a little bit geared per individual, but I would say that generally speaking, in the beginning, I want to see everybody about every 90 days or so after we first implement the plan. Over time, after we do several 90-day reviews, we might lengthen the amount of time between meetings, but I want to see everybody at least once a year no matter what, because I want to make sure that if anything's changed in your life, beneficiary changes, address changes, phone numbers, bank accounts, whatever it is, we want to make sure that we're not missing anything. So I want to see everybody at least once a year, but a lot of people I see every 90 days.
Some people come to you and this is the first time that they've retired and they want a plan from you, but others may come to you and maybe they have investments with another firm and they have to say goodbye to another investment advisor. Do you help with that uncomfortable process?
Yeah, so depending on the situation, I can be as involved or not involved in that process as you would prefer me to be. Some people feel like they have a duty to their financial planner to go back and their previous guy and say, hey, I'm leaving and here's why. Some people are like, hey, I don't ever want to talk to this guy again. He didn't do very well for me, or he did something wrong or whatever. And I understand that too. There are ways for us to change most, if not all, of the investments without ever talking to anybody if you want to. But I'm happy to make calls with you on the line, tell people what we're doing, whatever it is that we want to do. That also goes for your beneficiaries or your kids if you want them involved in this process in any way. A lot of people don't, but some people do. If that's important to you, if you have a daughter that you like to have around to help you make big decisions and things like that, she is more than welcome, son, whoever, is more than welcome to come into the meeting, and I'm happy to explain things as many times as is necessary for everybody to be on the same page. Because I feel like if we have a good understanding of what we're doing, then the plan just works so much better over time. Versus if we're too big in a hurry, or if we don't quite understand up front and we don't ask enough questions, then we're confused later on. I would rather everybody have a good understanding, and I'm willing to take the time and effort to make sure that we have that before we move forward.
All right, Jake, it seems like that you have done a lot of work for people with this 5-step process. It's several weeks. It could be a month or so. At what point, because you have done all of this work, do I ever write a check to Floyd Financial Group, or do I?
Yeah, so you'll never write me a check for anything. I do get paid, and there's various ways that I get paid, and I will make sure that I disclose all those to you. If I'm managing money in the market, I get paid directly out of the funds I'm managing. And again, you'll understand all that up front, but you will never have to actually write a check to me. I don't charge for my planning process. There are some financial advisors that charge for that. Personally, I don't think that makes for a very good conversation if you're constantly worried about how much time I'm spending because I'm going to bill you for it. I would rather just have good conversation. And if things make sense, great. If they don't make sense, that's okay too. We're in a good spot. So if it makes sense, I want to help people. But if it doesn't, that's okay too.
All right. So if our listeners have questions about this 5-step process, or maybe they want to get involved with this, it's very simple to do this weekend. Call 417-889-7233. Again, our telephone number, 417-889-7233. There's no cost for this consultation, this retirement roadmap, this retirement review. Certainly, there is no obligation, and of course, there's never any judgment whatsoever. We will meet you where you are right here at Floyd Financial Group. So if you've got questions, we may have the answers for you. I want you to write this number down and call it as soon as possible, 417-889-7233. Yeah, it's the weekend right now, and we're just here ahead of 4th of July. Why not get the second part of this year off to the right start by getting on a good financial path that will lead you to a confident retirement? Again, no cost, no obligation. 417-889-7233. You can also find out more about our firm online at floydfinancialgroup.com. It's floydfinancialgroup.com. Jake, we have had a great show. I know that a lot of people may have missed part of it. If that is you, you'd like to hear it all over again, or any part that you may have missed, remember, we're also a podcast. Go to wherever you get your podcasts and search for Show Me the Money with Randy and Jake Floyd. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Jake, out of time for this week. Thank you for your time, but most importantly, I want to thank our fine listeners here at the Last Bastion of Sanity, Springfield, Missouri, for joining us. For Jake Floyd, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor